How's it going, everyone? Welcome back. If this is your first time here, my name is Edgar, and this channel is about personal finance, real estate investing, stock market investing, and personal development. So if that is something you want to learn about, make sure you are subscribed. In today's video, we're going to be looking at the reason why many new investors lose money in the stock market. It's no secret that if you want to build wealth, you need to begin investing. But there's a right way to invest and a wrong way to invest, and if you start off your investing career on the wrong foot, that can have a negative financial effect. I'm sure we all know someone who has invested in the stock market and they ended up losing a big part of their investment, if not all of it. And even if you don't know anyone who had this happen to them, it's not hard to find examples of people who lost large amounts of money in the stock market. Now, this doesn't mean you should be scared of investing, but it should tell you that you need to learn what not to do when you are investing, and that's what I will go over in this video. So the first thing you shouldn't do when investing in stocks is become a day trader. I'm sure you've seen those advertisements where people claim they began with only a few $1,000s and they turned it into millions of dollars. And this get rich quick scheme is what draws in a huge number of people, especially when you are a new investor and you don't have any trading experience, or even if you have limited experience, you should still avoid day trading. About 40% of people who begin day trading only trade for about 1 month, then 80% quit after the first 2 years. Then after 5 years, only 7% remain trading and only 1% of day traders actually make any real money. But if that's not convincing enough, Charlie Munger, who has been Warren Buffett's longtime business partner, has said that teaching young people to actively trade stocks is like starting them on heroin. Now, I'm not denying that there are people out there that can make money day trading, but for the majority of people, day trading is not the way to go when it comes to investing in the stock market. The first reason most people do not succeed with day trading is that it requires good market timing. And even the biggest and most successful investors like Warren Buffett do not try to time the market. The thing is, there's endless number of factors that affect the condition of the overall market and the price at which stocks are trading, and it's impossible for any single investor out there to know and understand how these factors are going to affect the price of a certain stock in the short term. It very well could be that when you first start off, you get lucky and you make some good trades and you make some money. But for most people, that luck doesn't last very long, and what tends to happen is those initial wins makes people overconfident. But eventually, their luck is going to end, and when this happens, they will begin making trades that lose money. But they continue trading, thinking the next trade is where they will double their money, but that never happens, and instead they lose everything. So when it comes to investing in stocks, most people will be better off investing over the long term and not day trading. The second reason why many new investors lose money is they don't become educated on the investments they are considering. Investing in general always has some level of risk, but when you just jump into an investment without doing your research or understanding how the investment works, you are exposing yourself to unnecessary risk. If you simply took some time to become educated about the investment you are about to make, you could discover something important that could change how your investment works out. This doesn't mean you have to become an expert on how the entire US equity market works, but you should understand the basics of investing in stocks and what big factors can impact your investment. For example, you do not want to invest into a stock if you don't know how the business generates revenue, what market it operates in, or how their financial statements look. Maybe during your research, you'll find out the company is involved in a legal battle because one of their products is known to cause cancer and they never disclosed it. Something like this could really affect the overall business, especially if that product is a major source of revenue. Or it could be that the company has been the leader in their market, but recently a different company has been taking market share from the company you want to invest in, and this might or might not affect their stock price. But if you invest into that stock without doing your research, you could expose yourself to losses. In this scenario, spending some time doing some research could end up saving you thousands of dollars in losses. And it could even end up making you money if you discover the new company is a better buy and has more potential for growth. That many people begin trading investments they don't fully understand simply because a friend or someone else mentioned it to them. A great example would be trading options, and for those of you who don't know what that is, options are contracts that give the holder of those options the right but not the obligation to either buy or sell a certain asset at a predetermined price at or before the contract expires. When used correctly, options can really benefit an investor's portfolio, but when a new investor begins using options and they don't fully understand how options work, they can do more harm than good. Also, whenever you invest in stocks, you want to look out for any fees, and you must take into account any taxes you will have to pay once you sell your investments. To begin investing, you have to sign up with a broker where you can make your trades, and if you sign up with any broker without looking into their fees, you can end up paying high trading fees, which means less money to invest. But that's not a big issue anymore because now there's multiple brokers who offer free trades. However, this is not the case when you invest in mutual funds because they still have high fees, especially when compared to index funds. The fees on mutual funds vary, but let's say you have $500,000 in your retirement account and you are invested into a fund that charges 1.5%. That means you are paying $7,500 every year just to be invested in that fund. And many mutual funds underperform the market over the long term. So in this case, you would be way better off investing into a low-cost index fund that only charges 0.04%. Also, something else that many new investors don't take into account is taxes. Whenever you sell any of your stock for a profit, you will pay taxes on that gain, and you can either be taxed at the income tax rate, which happens to be one of the highest tax percentages, or you can be taxed at the capital gains rate, which happens to be lower. For your profit to be taxed at the capital gains rate, you have to own a stock for more than 1 year. So if a new investor didn't bother doing research on this and they saw their stock right before it's been a year, then they could end up losing out on hundreds, if not thousands of dollars, because now they're paying more in taxes. So whether you're buying or selling investments, you should spend some time doing research and gather as much information as you can, because that can be the difference between having more money in your pocket or losing it all. The next reason why many new investors lose money is they make investment decisions with emotions and not logic. This is more true when you're just getting started, because you've never experienced firsthand what it feels like when there's volatility in the market and your investments begin going down in value. And when you make investment decisions with your emotions, you will get nervous or scared, and if you sell during a dip in the market, you could sell for less than those investments cost you. And once you sell, you lock in any losses. Let's say you invested in some Apple stock and you did plenty of research and that told you Apple was a strong company, but one day the share price drops. Now if it's a small drop, then chances are it won't bother you, but if it's a big drop and it happens fast, you could begin to second guess yourself. But whenever this happens, you should analyze if the core business is still doing good. And if it is, then you should look at this situation as a buying opportunity, and you should consider buying more shares, not selling. Now, it can also be the other way around. For example, if you bought Apple stock 3 years ago and when you did your research back then, the core business was still doing good. But now many things have changed and the core business is not as strong as it once was. But you ignore that and you decide to hold on to a stock because it was one of the first companies you invested in, and you hope that the business can recover. But in reality, the business continues doing bad, which causes the stock to drop by a huge amount. In this scenario, your emotions made you hold onto a stock when you should have sold it. And if you would have used logic, then you would have realized it was time to sell that stock. And at that point, it's possible you could have sold it and still walked away with some decent profit. Or in a worst case scenario, you would have had a small loss, but it would have been limited, which is way better than losing your entire investment. Also, when you hear other people talking about different stocks they own and how they made thousands of dollars with a certain stock, or they talk about how they make money with different investment vehicles, it becomes tempting to follow what they are doing. But this is you having fear of missing out, which is the same as making investment decisions with emotions. And that leads us to the next reason why many new investors lose money, and it's because they don't have their own investment strategy. When you're investing without having your own game plan, you will end up investing in a way that doesn't help you achieve your financial goals, and you're more likely to jump on bandwagons and follow trends blindly. The thing is, everyone has different investing goals, different levels of risk they're willing to take, and different resources. So something that works for someone else might not work for you. So you must develop your own rules for what you will invest in and how you will allocate your assets. For example, if you don't normally invest in IPOs because you like the company to be public for some time so you have more data for your research, but during a family gathering your uncle begins talking about investing in this new stock that is going to double in price and how he invested $10,000, then someone else tells you how they invested $8,000, and someone who doesn't have their own investment guidelines will jump on the bandwagon, and if the stock they were talking about was Lyft, then you would have lost money. Or let's say you're someone who doesn't like taking on risk. So in that case, investing in individual stocks wouldn't be within your investment strategy, but investing in index funds would be, since they are considered to be safer investments. So by having your own guidelines and rules for what you will invest in and what you won't, you will be better off in the long term because the investments you make will benefit you and help you reach your goals. The next reason why many new investors lose money is they think they can get rich overnight. Many people invest with the intention of making profit right away, and they think if they invest $1,000 today, they will have $10,000 tomorrow and then $100,000 in a few weeks. That's not the way investing works, at least not over the long term. Many people claim they double their money every few months or even every year, and that might be true for a short period of time, but that will not be sustainable over the next 10 or 20 years. And if for whatever reason they are able to do that, then why aren't they the head of some major bank on Wall Street? The answer is because they are not able to achieve those returns over the long term. Even investors like Warren Buffett don't double their money every year, so don't fall into a trap thinking you will be able to do that. Everyone is going to have a period of time when their investment goes up by 50 or even 100% in 1 year. And when this happens, it's hard not to feel like you're some investing god who can pick all the big winners. But the odds that you will be able to get the same results with all of your investments is not very high. For example, if you bought Tesla stock when it was around $200, then you sold it when it was around $800, you might think you will be able to do that with every stock you buy and you will be rich in no time. But the truth is, not every stock you buy is going to have the same result. So don't become overconfident and think your timing will be perfect with every investment. And this also applies to thinking you can give your money to someone else and they will double it for you and make you rich. I mean, just look at what happened with people who invested with Bernie Madoff. A lot of people thought he was this great investor who achieved amazing returns, but it turns out he was just running the biggest Ponzi scheme in history, and as a result, many people lost their entire life savings. So if anyone ever comes to you with an investment opportunity that will get you amazing returns and they ask for your money, you should be very careful. Whenever you begin investing and you are under the impression you can get rich quick, you will begin taking bigger risks, and it might pay off in the beginning, but eventually your luck will run out, and when this happens, you can find yourself losing large amounts of money, and this can set you back financially for many years. So with that being said, those are the main reasons why many new investors lose money. If you found any of this information helpful, don't forget to drop a like and subscribe. Thanks for watching, and I will see you next time.